Ever wondered how an S corporation could impact your taxes? Let's start by defining what an S corporation is. It's a special type of corporation that's created through an IRS tax election. Unlike traditional corporations, also known as C corporations, an S corporation isn't subject to corporate income tax. Instead, its profits and losses pass through to shareholders and are reported on the shareholders' individual tax returns. Now, how does an S corporation differ from other business structures? Well, a sole proprietorship is a business run by a single individual without any legal distinction between the owner and the business entity. A partnership, on the other hand, involves two or more people who agree to share the profits or losses of a business. Both these structures are subject to self-employment taxes, which isn't the case with an S corporation. The advantages of an S corporation can be substantial. For starters, the pass-through taxation model can help avoid the double taxation issue that C corporations face. Additionally, shareholders of S corporations can also be employees, and their share of the company's profit is considered as distribution, not self-employment income, potentially reducing the self-employment tax burden. But it's important to remember that S corporations come with their own set of limitations. For instance, they can only have a maximum of 100 shareholders, all of whom must be U.S. citizens or residents. And unlike C corporations, S corporations can only issue one type of stock. Deciding to become an S corporation is a significant step with potential tax benefits, but it's not for everyone. It requires careful consideration of your business goals, the nature of your operations, and your long-term growth strategy. So how does an S corporation handle taxes? Well, it's all about the unique taxation model of S corporations, known as pass-through taxation. This essentially means that S corporations themselves don't pay federal income taxes at the entity level. Instead, they pass profits and losses through to their shareholders. Now you might be asking, what does this mean for me as a shareholder? Well, this is where it gets interesting. Those profits or losses that are passed through, they don't just vanish into thin air, they end up on your individual tax return, directly impacting your personal tax obligations. It's important to note that this pass-through mechanism isn't just about profits. Losses too can be passed through, which can help offset income from other sources and potentially reduce your overall tax liability. However, it's not all sunshine and rainbows. The pass-through taxation model can be advantageous, particularly for businesses that make a significant profit. But it also means shareholders bear the burden of tax obligations. So in essence, the profits you make as a shareholder could also mean a larger tax bill. How do S corporation profits and losses affect shareholders' taxes? This is a question that many shareholders find themselves asking. The answer lies in the heart of S corporation taxation, which operates under a system often referred to as pass-through taxation. In this model, the profits and losses of an S corporation pass directly through to the shareholders. This means that these profits and losses are reported on individual tax returns and not at the corporate level. This can have a direct impact on the amount of tax that a shareholder is required to pay. One of the key elements of S corporation taxation is pass-through income. This is the income that the corporation earns and passes on to its shareholders. It's important to understand that this income is subject to federal income tax, but it's taxed at the shareholder's individual tax rate, not the corporation's tax rate. This can potentially lead to a reduction in overall tax liability, particularly if the shareholder's personal tax rate is lower than the corporate tax rate. But there's more to it. As an S corporation shareholder, you are required to pay self-employment taxes on your share of the corporation's profits. These taxes are used to fund Social Security and Medicare, and they are typically split between the employer and the employee in a traditional employment situation. However, in the case of an S corporation, the shareholder is considered both the employer and the employee, meaning they are responsible for the entire self-employment tax. It's worth noting that there can be potential benefits to this system. For instance, S corporation shareholders can potentially reduce their overall tax liability by splitting their income between salary and dividends. Dividends are not subject to self-employment taxes, which can result in significant tax savings. However, it's important to remember that being a shareholder in an S corporation comes with unique tax responsibilities. It's essential to stay informed and understand how these rules apply to your particular situation. Being a shareholder in an S corporation can offer potential tax benefits, but it also comes with unique tax responsibilities. How does one balance between paying a salary and receiving distributions as an S corporation owner? This, my friends, is the million-dollar question. As an S Corporation owner, you have the unique opportunity to draw money from your business in two distinct ways: through a salary or through distributions. Here's the catch. While both are forms of income, they're taxed differently. Your salary is subject to both income tax and self-employment taxes. Distributions, on the other hand, are only subject to income tax. This means, generally speaking, you could potentially lower your overall tax liability by taking more income as distributions rather than salary. But hold on, don't get too excited just yet. The IRS requires that if you perform services for your S corporation, you must pay yourself a reasonable salary before taking distributions. And what's considered reasonable? Well, it's a bit of a gray area, but it's generally understood to be what you'd pay for similar services in your specific industry. Why does this matter? Well, if the IRS determines that your salary is unreasonably low and you've taken high distributions, they may reclassify your distributions as salary, subjecting you to additional taxes and penalties. So the balancing act begins. Finding that sweet spot between salary and distributions can significantly impact your tax responsibilities and your bottom line. The salary versus distribution decision is a crucial aspect of S corporation tax planning. What compliance and reporting requirements come with maintaining S corporation status? The answer lies in a mix of diligent paperwork, stringent adherence to forms, and an unflinching commitment to compliance. As an S corporation, you must complete and submit Form 1120-S, known as the U.S. income tax return for an S corporation. This form provides the IRS with an overview of the corporation's financial activities for the year. Beyond this, Schedule K-1 forms are an absolute necessity. These forms detail each shareholder's share of the corporation's profits, losses, deductions, and credits. It's not just about submitting these forms, but getting them right and on time, as they play a crucial role in the shareholders' individual tax returns. The S corporation must also adhere to annual meeting and reporting requirements, maintaining minutes and records, and ensuring that all shareholders have access to important documentation. Let's not forget about employment tax reports if the corporation has employees. Regular filing of Form 941, the employer's quarterly federal tax return, and issuing W-2 forms to employees are some of the key employment tax obligations. Remember, the IRS is not lenient with non-compliance. Adhering strictly to these regulations is the only way to retain the benefits of S corporation status. Staying compliant is a must to enjoy the benefits of S corporation status. Who can elect to become an S corporation? Is a question that often pops up among business owners. The eligibility criteria to become an S corporation are quite specific. First off, the business must be a domestic corporation or a domestic entity eligible to be treated as a corporation. The business can have no more than 100 shareholders, and these shareholders must be individuals, certain trusts, or estates. It's important to note that partnerships, corporations, and non-resident aliens cannot be shareholders. Moreover, the corporation can only have one class of stock, meaning all shareholders must have the same rights to profits and assets. Lastly, the corporation must timely file Form 2553 with the IRS to elect S corporation status. This form must be filed no more than 2 months and 15 days after the beginning of the tax year when the election is to take effect. So, as you can see, not every business can become an S corporation. It's essential to understand these requirements to avoid any potential legal and tax complications. Knowing the eligibility criteria is the first step towards electing S corporation status. How can you leverage the tax advantages of S corporations? That's a question many business owners ask. Well, the key lies in effective tax planning. Let's delve into some strategies. Firstly, optimizing deductions is crucial. As an S corporation, you can deduct ordinary and necessary business expenses, so keep track of those expenses and claim them. Another important aspect is managing shareholder compensation. Balancing between salary and distributions is vital, as it directly impacts your self-employment taxes. Paying a reasonable salary while taking the remainder as a distribution can be a potential strategy to lower self-employment taxes. Maximizing tax savings is the ultimate goal. One way to achieve this is by leveraging the qualified business income deduction, a tax break that allows S corporation shareholders to deduct up to 20% of their business income. Remember, every business is unique, and strategies that work for one may not work for another. It's always wise to consult with a tax professional to tailor a plan that fits your business's specific needs and goals. Effective tax planning can help S corporations and their shareholders reap substantial tax benefits. What do the experts say about S corporations and taxes? Well, tax professionals, accountants, and business advisors have a wealth of knowledge to share. For instance, many experts suggest a balanced approach to salary and distributions, highlighting the potential tax savings while cautioning against the risk of IRS scrutiny if your salary is deemed unreasonably low. Consider the case of a successful tech startup that elected S corporation status. After a banner year, the owners decided to take the majority of their profits as distributions, paying minimal salaries. While this strategy initially resulted in significant tax savings, it eventually caught the attention of the IRS, leading to an audit and substantial penalties. On the other hand, we have the story of a small family business that used the S corporation structure to their advantage. By working closely with their accountant, they were able to determine a reasonable salary level, while also taking advantage of distributions. This balanced approach allowed them to enjoy the benefits of the S corporation structure without raising any red flags. Both scenarios underscore the importance of expert guidance in navigating the complexities of S corporation taxation. The right advice can help you maximize benefits while staying within the lines of IRS regulations. Learning from experts in real-world scenarios can provide valuable insights for your S corporation tax planning.